Best ever listeners, welcome to the Best Ever CRE podcast. I'm your host, Joe Cornwell, and today I'm joined by Fuquan Bilal. He is the CEO of the NNG Capital Fund. They are based in New Jersey and investing in multifamily in multiple markets, including the Southeast, and doing some new construction homes in the New Jersey market as well. So Fuquan, welcome to the show. How are you today?
Thanks for having me. I really appreciate it. It's an honor to be here.
Well, we appreciate your time today. So I know you mentioned it's your first time on the show and you have been in the real estate business for over 26 years. So why don't you walk us through a little bit about your background, where you're from, and how and why did you get into real estate?
Well, yeah, so it's been a 26-year journey as we was talking about, and I'm grateful for every day. And I was having a conversation a few weeks ago, and I wouldn't change anything that has happened over that 26 years because a lot of the mistakes that I've learned has made me the person who I am today, right? Just anything in life, whether it's real estate or whatever you do. But I started off in corporate like everyone else into sales and then transitioned into real estate in 99 and kind of jumped out the window and grew wings falling down, as they say. Started off, I'm from New Jersey, Newark, New Jersey, born and raised, low income area, single parent household. So the hunger has always been there to want more. I gravitated towards sales. And I had a sales job in corporate, as I just mentioned, and then transitioned to real estate in 99. And when I got involved with real estate, it was more of the fix and flips. Back then, it was, being a young kid, 24 years old in the business, making $30,000, $40,000 a transaction was a really good feeling coming from where I came from, a poor environment. So I really enjoyed that and went through the early phase of my life of materialistic stuff and, whatever money can get you, traveling, everything else, and really grew up fast through the GFC, the global financial crisis in 2008. And, it took me about 2 years to pick my face up from the ground. 2010, started to get some traction, and I transitioned over to the note business and, learned how to buy notes directly from the banks. These are bank originated notes, not seller finance. Played that space for a while, for a few years, invested in some of my own capital. And then I created my fund in 2013, the first fund that we created, NNG Capital Fund, and started to raise capital from there for, notes. And, all the way up to about 2017, we just invested heavily in notes and then transitioned to create more diversity in a portfolio and started to bring back those fix and flips. And today, fast forward, we have a hybrid strategy where we only have the luxury spec homes that we do here in New Jersey, where I have all my relationships for the last 26 years, and also multifamily in the Southeast. So it's kind of a hybrid, diversified strategy to try to mitigate, risks, if you will.
Yeah, no, that's an amazing journey, and there's so many things in there I want to, kind of peel back. But let's start with the global financial crisis. I'd love to talk to investors who are seasoned, who have been through now a few cycles that we have seen, and obviously in your time in the business, because I think it's always a unique perspective as opposed to my generation, right, who came in after 2008 and have only seen, pretty much that kind of up and right to the growth until recent years. So what were you doing, in that time? I know you said you did a lot of flips, but what were you holding and what kind of problems did you run into in your business leading up to that global financial crisis?
So at that time, I was managing $10 million in assets. These were single family properties that, I was using some hard money, some private lenders, and had properties in South Philadelphia and also in Newark, New Jersey, and areas around that were the same. And it was a lot. I mean, I was actually in the field running the construction, doing all of the mundane, arduous, crazy work as I look back on it now. But we all go through that phase, right? So, just cracking at it every single day, pushing. And I was young, so I had all the energy in the world to do that. And I learned a lot about construction and dealing with people and relationships. And then before 2008, started to create more relationships with investors. I started off with the landlord of the building that my office was in. He started to see what I was doing and, approached me one day and, we had lunch and he became an investor. Then his friends started to invest and it just went from there. So it was really just focusing on the flips. I really didn't get into any rentals back then. Making $200-$300 a month on a property wasn't sexy. It was like, I'm not going to do all this work to fix the property and go through all this with the contractors and run a Home Depot every day and just to make $200 a month. But I didn't understand appreciation. I didn't understand the power of cash flow until the GFC. So when that happened, It was a major shift. I always try to laugh when I talk about it because it was a point in my life that was an inflection point, if you will.
Hmm.
Because once I was married at the time. Once you have a strain on finances, the household is different, and real estate was my identity. Right? Without real
Mm.
estate, I didn't know who I was. So when the bank stopped lending and feel like the rug got pulled from underneath your feet, it was really hard for me, and I had to make a decision, which I got a lot of bad advice, even from my CPAs at the time. Hey, just file bankruptcy, start all over again. But I knew I had these private lenders money from their IRA accounts or their savings, and I couldn't let them down. So I had a lot of my money invested also. I lost a lot of my money. What I did was just basically at that time, you can get a property in the market cheaper than a short sale or anything else. So just started to fire sell a lot of properties, paid off the lenders, and took the loss. And what I learned from that was the relationships are important, no matter what challenges that you go through, especially if you're raising capital, is to communicate to your investors, stand tall, do the good, bad, and ugly, share that information with them in real time as it's happening, and you'll see things will work out in the end. So, to fast forward to today, I manage way more than back then, capital wise and also asset wise. So, it was a wake up call for me. It was a lesson. I have the battle scars
Yeah,
from the GFC.
absolutely, man. That's and it's one. Kudos to you for actually paying back your investors. Talking to investors who lived through that cycle. A lot of them went bankrupt. A lot of them lost all their assets, their personal finances, all that. And of course, a lot of them weren't able or willing or whatever. It didn't work out where they were able to pay back their investors, and that was not a common thing from my understanding. On deals that went sideways. Like you mentioned, some of the things that kind of happened in your portfolio, and I don't want to spend too much time on it, but like, what are some of the specific examples? Like maybe a deal at the time that, because of the chaos in the market itself, led to that deal falling apart, and some of the lessons you took from that into your future endeavors.
So during that time, actually, acquisition wasn't an issue, right? So we had inventory of assets. We were doing a lot of construction. I would answer the question by saying deals we had in the pipeline to close. Those were the deals that were really painful, that was at the closing table blowing up the day of the closing.
Wow.
Or the lender pulling funding from the borrower.
Meaning you're selling. So this is these are dispositions that got blown up at the closing table. Okay.
And it was just a domino effect, back to back. This week it'd be these two deals, next week it'd be those two deals, until it wound up, I think I had 7 deals at the time, and 2 wound up closing. The other 5 didn't. And those had to be sold for less just to get rid of them, to make investors whole and pay off the lenders. And then all the stuff that was in construction, I had to strategically either do loan assumptions to buyers that were willing to do that, other investors, and pay off the investors that may have been in second position, or if I was fully in second position, I took the loss on it just to get rid of the portfolio. I mean, one thing that I'm grateful for, that real estate did allow me to have other businesses during that time. So that was the main cash generator. I was able to open up a car wash. I opened up a hair studio with 25 chairs that I used to rent the chairs to. So I had other businesses and things that had cash flow. And then the ones that I couldn't sell, I actually was forced to become a landlord. I remember, going through the divorce, going through those challenges, and riding around old school with my rent receipt book in the back seat, my 2 kids in the car, going around to collect rent. And I've never done that before because I was just a flipper.
Yeah.
So it kind of forced me to become a landlord. Back then, you didn't have Appfolio or all these other sophisticated systems. It was you and a tenant and your receipt book. So, that's kind of how I managed it back then, Excel spreadsheets and everything, and slowly started to understand the importance of cash flow and rentals. And then I got into the note business, and that things just took off a few years later after that.
Yeah, well, that's awesome. I love the fact that you were diversified in multiple things. I feel like I'm kind of at that point in my journey as well, where I've started investing and becoming partners in a couple other, businesses, in the hopes of growing the cash flow and revenue from a little bit diversified streams. Not everything in my own business I operate or my real estate holdings. So, I love that. And, it's funny nowadays, like, looking back at that, a lot of people will tell you, if you're making money and you're successful in one thing, really drill down and focus and grow that one thing you're good at, right? Like really, really excel at one thing before you start diversifying and putting money in other aspects or time in other aspects. What is your theory on that? now in hindsight?
Yeah, it's funny you asked that because I had read a book back then called Multiple Streams of Income.
Okay.
And my takeaway from that today is multiple streams of income within real estate, right? There's some people who buy businesses and a friend of mine owns like 100 businesses. It could be coffee shops or different things, but
Yeah.
he's investing in businesses that's already up and running where they have an integrator or owner in place. And he's just bringing the operational tact to it to make it a little bit more sophisticated and to run smoothly, right? He's not in the business. So back then I was in the business trying to be the jack of all trades, and it kind of just spread me thin, right? So what I learned is, for me, because I love real estate, is just to focus on multiple streams of income within real estate. You can, it's not saying you can't be successful having a real estate business and other businesses, but you should have an integrator, a vice president, or somebody who's running that business where you can just, feed into them and give them different ideas and play that visionary role. So that's kind of what my takeaway was during that time, and what I have even for today.
Yeah, that makes sense. Okay, let's. Well, actually, I have one question. So, one of my business I'm invested in it has a salon component, right? Where we have the chair rental, like you're talking about. I'm curious, what were people paying for booth rent? Almost 20 years ago.
Yeah, it was $250 a week.
Okay.
$250 a week.
Wow,
25 chairs.
And it hasn't gone up that much since then, at least in my market. I'm in Ohio.
And I owned the real estate too.
Okay.
So it was great because the business, there were 3 different businesses. It was a women's salon on the first floor, a barbershop on the second floor. The third floor, the front, had a private barbershop and a tattoo spot in the rear. And then all of those, every chair paid rent. So it kind of worked out.
Okay. And so you were salon lofts before salon lofts.
Yeah, and it was like a loft style setup. It was high end and everything else, and it was in a hood, so people were attracted. When you came inside, you kind of forgot where you were.
Okay.
But we used to do a lot of marketing to the radio stations, the hair shows, pass out flyers at the clubs. We did all that for them to bring the walk-in traffic to kind of help support the business owners. And more like today, where you see people renting booths, the stylist or the barber is responsible to promote themselves, right?
Right. That's true. I guess that makes sense.
We did a lot of the promotions, so that came with it. We did back to school drives where we had radio stations come to the salon and we gave kids free haircuts. We did a lot of charity stuff. So it was really something that kind of gave me a feeling of importance coming from that area. It was like a give back, employing people and also keeping it in the real estate format by renting the chairs and everything else. So, but it wasn't easy. It wasn't easy.
I love that. Yeah, I mean, salon, man. So I learned more about salons the past year investing in that business than I ever wanted to, but I really like it. I see a lot of potential, and it's one of those things that's internet resistant, right? It's a service business. It's not, that's the problem with real estate. When you look at commercial real estate, there's so many things out there that are susceptible to going away from brick and mortar, and services industries like salons and spas and things like that are internet and somewhat recession resistant. So. Awesome. Well, let's talk a little bit about your note business. Tell me. I mean, so I know a little bit about it. I've not invested in any notes, but why don't you break it down for us a little bit? Tell us what it is, why you got into it, and what your journey was like.
Yeah. So if you guys remember back then, I forgot the name of the show when it was about the banks. I forget the name of the show. If I could think of it, too hard to fail or something like that. Whatever it was, and you probably
too big to fail.
Too big to fail. Yeah.
Okay.
Too big to fail. So that kind of painted the picture of what happened during that time through the GFC, right? When they were anybody who could fog a mirror was getting a loan, they were securitizing them, selling them off. So during that time, when the banks were in trouble, they stopped foreclosing because they didn't stop, but they kind of slowed down the foreclosure process from the foreclosure mills. And then they started to sell off these loans. So a regular person like you and I can actually buy directly from the bank. And that was unheard of, right? That was something that I didn't even know existed. Where I discovered it by doing a short sale, and the negotiator said, why don't you just buy the note? And I'm like, what are you talking about? Well, we can assign everything over to you, become the owner, and you just deal with the homeowner. And that's when I got curious and started to investigate, learn about it, and got involved with it. And, had some connections of some hedge funds that were buying these notes in bulk from the bank. And then they would get rid of the red-headed stepchilds, the low balance loans, anything less than 100,000 unpaid principal balance. They would carve off the tape, sell those off for 15 cents in a dollar.
Wow.
Oh, that was back then. It was,
Well, give me an example deal so I can wrap my head around the numbers here.
A $50,000 loan will cost me, $5,000.
Wow.
But the debtor still owed $50,000 plus the interest. So what was good about that is it was a laptop cell phone business, right? I would buy the paper, which is an asset because there's a recorded mortgage attached to the property. And some of these were second mortgages because remember before they were doing 100% financing where they were doing 80% and 20%.
Right.
So a lot of that paper that I was buying was a lot of the secondary loans that was behind the first that was probably underwater. So they would get rid of them. They would probably book charge off the debt, sell them for 10 cents on a dollar, 15 cents on a dollar, just depending on if there was still equity above it or no equity above it. So you have full equity seconds, partial equity seconds. So it was a lower barrier to entry, if you will, where I can, for 100,000, I can buy 10 loans, right?
Wow.
So kind of played around in that space for a while. And it was fun because you can help the homeowner, right? The same example I gave you, 50,000 unpaid principal balance. I paid 10,000. I paid, 10% of it. It cost me $5,000. I can now go to that homeowner and go, hey, if you give me $20,000, we can eliminate this debt.
Wow.
If you give me $15,000, we can eliminate this debt. And I still would make a great return on that, right?
Yeah,
Or
yeah.
I can say, I'm going to wipe out all the arrears and you start to pay me, give me $1,000 and you can start to pay me $600 a month.
Okay.
And this is for a note I paid $5,000 for.
Right. So your ROI is huge on this if you can get it to perform. Right?
Yeah. But it's a business. Second mortgage is a business. There's a lot of loans you buy, especially, once you start raising money, we start buying tapes for like $1 million. We were getting, $10 million worth of debt for $1 million. So, and you have to work through all those loans. It could be small balances, 20,000, 50,000 here and there. Right.
So it's a lot of people to people stuff.
Correct.
Yeah.
It's worth it though, right? It's like credit card debt, essentially, right? And I learned about credit card debt and debt on auto loans, so many things that I learned about paper, right? So I actually wrote a book called, Investing in Notes that you can find on Amazon where I kind of broke down my experience in the business and everything else. So if anybody listens to this, they can go to Amazon and they'll see that business still exists today, but it's heavily regulated. Years later, Dodd-Frank came in, started to put the regulation in. Then, after COVID, it's like, nobody wants to be a collector.
That's what I was going to say. That was my next question. Is like how big is
Wild,
that
Wild
market
West
today? Yeah,
back then it was the Wild Wild West.
Yeah, I got you.
Everybody started getting educated. I would educate people to make them buyers, right? So I needed to create a downline. So I would go out and educate people on how to get involved in this space. So when I was able to buy from the hedge funds or directly from the bank, now I can carve off a certain portion of those assets, sell them to my downline, recapitalize on my spend, and work some out and keep doing the same thing. The most profitable part of that business is exiting through the homeowner.
Right.
Because either you're going to get the property by a deed in lieu of foreclosure, or you're going to be able to work something out where you could reperform it and then sell it. And that same example that I just gave you, if I paid $5,000 for the loan, and let's say I had to spend $3,000 on foreclosure to get the process started, because more than likely you have to start the foreclosure process so the homeowner will work with you, right? Like a game of chicken. Right. Once they work with you, you can now sell that loan, depending on the yield that the buyer wants. You can sell it as a reperforming loan. So you collect 6 months worth of payments or a year worth of payments. Now that $50,000 UPB, if you're collecting $600 a month, you can sell that loan for $25,000, right? So if anybody had $25,000 in the bank, they're not making $600 a month off that, right? So, it's a great return for somebody that want to buy that debt. Now you made a return, you paid 5, you put 3 into foreclosure, you're in it for 8, sell it for 25, you make a profit, you just rinse and repeat the same thing.
Yeah, that's
so it was a great space. And we played that space from 2013 heavy all the way to, I would say, 2017, 2018. Yeah. And we started to pivot out a little bit because it started to get really expensive.
Yeah. That's a great, great lesson. And I often say, as I get older, I get a little more mature, I get a little more experience in real estate and business and all these things. It's like one day I want to just be the bank, right? That is the most passive type of investing you can do when you're lending money, when you're a passive investor, that you see why, at least here in America, so much of our culture, our economics, the laws, everything governing business is so favored for the banks. The banks are like the golden child of our economy, right? And so I see all the upside in becoming more and more invested into that space of, within real estate or business or whatever. Like you mentioned, there's so many segments of that, the loan industry, but it makes a lot of sense.
Yeah, it was a cool business. They say be in the bank And note investing is the best investment strategy in the universe.
Yeah, yeah, I believe it. I mean, I believe it.
It's
I've seen it.
laptop and cell phone,
Yeah.
purely active. There's some active, it's passive, but there's some small active stuff that you have to do. And what I learned over the years, the only person that makes all of the money in that space are the attorneys.
Yeah, I mean that's the case in
Yeah.
any instance with an attorney, right? Yeah, that's great. Okay, so you transition from the note business into multifamily in these spec homes. I do want to spend a little bit of time talking about these ground up homes you're doing. So, are you doing land entitlement? Are you actually GCing or having your company do the building side? Like, what does that business look like?
Yeah, so after COVID, before COVID, like I said, around 2017, we started the transition of the strategy to adding more real property back into the portfolio with the notes. And then around 2019, we just said, you know what, we're going to go full with buying more, getting into multifamily and also more of the fix and flips because those are more profitable. I can control the outcome of a fix and flip profit versus a homeowner that want to pay me, on a loan. So we started to notice foreclosure started to increase expenses, so we transitioned. We did that all the way, still in the low income areas, flipping houses, right? Because it was something that I already knew, already had a process built, relationship with contractors and banks at this time. So banks would sell me the REOs now because I had those relationships with them from buying notes. Yeah. Now they would have these REOs in judicial states where nobody wants to really buy notes because it takes long to foreclose in New York, New Jersey. So I had banks that would sell me tapes or portfolios of REOs. So I would carve out, they would let me cherry pick. I would buy 10, 12, 7 properties at a time and start rehabbing. And it just became like rehab mania all the way from 2017 to all the way to COVID. How I transitioned into the luxury spec homes, because when COVID came, being the New Jersey Democratic judicial state, a lot of the tenants were COVID. I don't have rent. So it was more tenant friendly than landlord friendly. So it was a wake up call for me. Good thing at that time, most of our rentals that we had were Section 8 because that was what we did in Jersey. So we got paid for those. The ones that were not Section 8, we didn't get paid because of the COVID things. There was some local stuff that the municipalities had, grants and stuff you can apply for. So we did everything we can to kind of cure the bad debt situation that we were accumulating from tenants not paying. After that point, we saw the market went crazy. It was like a dead cat bounce, as like one of the economists, John Burns, I heard say. And New Yorkers were coming over paying 30% over list price. So I saw that as a great opportunity to divest that portfolio of rentals in New Jersey, as well as look at going to buy more of the multifamily in the Southeast, but also transitioning to buying the spec homes, right? So competing with the builders, because at that time we were raising enough capital to compete with the builders. So we started to average purchase price in the low income area was $185,000 for a house. At that time in 2021, average acquisition in the higher area was, 400, 450. So the profits, look better. The buyer pool of the buyers, once you fix the house, were better to be qualified. Buying a house that was 700,000, 600,000, you have a more qualified buyer than someone buying a house for 250 or 350, right? So you don't have to worry about people breaking in, stealing things. You can leave stuff on the lawn for a week, materials and supplies in a better neighborhood. So, light bulb went off and I was like, okay, this is where we're going to go. So as we begin to do more of that and raise more capital, we started to realize that, just going in and fixing and flipping is not enough. We want to compete on a higher scale. And then we realized tearing a house down and rebuilding it is way more profitable. It takes a little bit longer, so your cash conversion cycle slows down a bit, but the profit is really huge when you do that. And you can predict the expenses, right? So when you go do a gut rehab, you don't know what the foundation is like. You don't know what this is like. So you have all these surprises that you get that eats up your profit. So the ground up projects are more predictable as far as expenses. You can build a better streamlined process and they're more profitable because people want to buy luxury and they come with a 10-year builder's warranty. So that's another.
Now, so is this your company actually handling from land acquisition all the way to final sale, or like what role were you guys doing?
Correct. So we deal with realtors, wholesalers. We have direct to seller campaigns going on. Whichever way we can generate the lead, we'll buy it. We'll tear the property down if there's an existing property there.
So this is infill building. So you're doing like one off in the neighborhood.
Correct.
You're buying a lot, putting it in a house.
Yeah.
Okay.
I mean, our average medium home sale price is $650. So
Okay.
it's different from like North Carolina, where you can go buy a tract of land, subdivide it, get the entitlement, and build,
Okay.
20 houses. A little bit different, right?
Sure.
I have a lot of friends of mine that play that strategy, where there's no basement and they just put like a slab and build, and they can do 100 houses a year, right?
Hmm.
Our model is a little different. The average sales price of our house is anywhere from 1.5 million all the way up to, maybe we just listed the highest one for 2.6 million.
Wow.
So
And you're buying the existing lots for, like you said, 650.
yeah, anywhere
Okay.
from 650. The last acquisition we had, we paid over close to 800,000 for the lot. We tear it down, cost us $1 million to build. We can resell it for 2.6, 2.7.
Okay.
Yeah.
Nice.
So it's
you're all
average
in?
anywhere from 350 to $500,000 profit.
Okay.
That can take anywhere from a year to 18 months.
Okay.
From
And
beginning to end.
that's from close to close.
Yes.
Okay. Yeah, that's great. Yeah, I love that model. Like, as I mentioned before we started today, my background is I have a construction company, and we do a really heavy value add on existing real estate, on the stuff we buy and hold. But we started getting into some ground up construction for contract work, and we're trying to get into doing that for ourselves, as you mentioned. So doing some spec homes or even tract home for our own builds to sell, and then doing some new ground up construction on commercial and multifamily development. But it's really difficult, at least in Southwest Ohio. It's really difficult to find those areas where it makes sense, with the cost of construction being so expensive today, cost of materials, cost of labor. As you said, buying even existing, if you're doing infill building, buying existing buildings and assets on land that you then have to tear down and rebuild. Obviously, going through all the zoning, entitlement, everything. It's not easy by any means, but I love the fact that, I think you kind of alluded to it, you have a lot more control of the process and hopefully the outcome, right? When you're trying to compete on existing multifamily, for example, you have dozens of people offering on those assets. But if you can find something like a lot to tear down and rebuild, well, now you're going to be able to create a good deal that you don't have as much competition on.
Correct. And what I like about the construction, I said you have a construction background, is everything is process driven. Mm-hmm. Especially when you're doing the spec homes. I was just at my mastermind last week, the Collective Genius, and we had a room where they talked about construction. It was like an AA meeting for construction. Everybody was talking about the pain points, the challenges. Yeah. And I was like, hey, we actually got it down to planning in a PowerPoint presentation with every piece of the house, and then transitioning that into scope of work for the contractors on a QR code, where we actually go to the house and tape it to the windows. If windows are not in yet, we'll laminate it and staple it to the 2x4s so they can scan and kind of see the process, right?
Wow,
so
I like that.
It's process driven from that, even from once the foundation is built, to framing, to MEP, to whatever. Everything is process driven. So if you couldn't get a process and always refine your SOP for, that part of the business, it's never perfect, but you can create more efficiency, which cuts more time, cuts more costs. You can do letter of commitments to your vendors to get bulk pricing without even having the material shipped. You could just, send a letter of commitment and say, I'm going to buy X from you over this amount of time, but I need you to lock me in this price.
Right.
So if you have inflation or whatever happened, you're still locked in. So there's a lot of things you can do to kind of manage that.
Yeah, I mean, you were dropping just nugget after nugget of wisdom here. I mean, I can tell talking to you for the last 30 minutes or whatever that you have learned a lot in your 26 years in business, because
it's still never enough. Like, the more you learn, the more you find out you don't know nothing.
I literally just said that to somebody on the show a couple weeks ago. I was like, the one thing I've consistently learned, the older I get and the more I learn, is just how little I know. That's the every time. It's like every 5 years you can look back, and every 5 years you think you understand stuff. And then you look back 5 years like, man, I didn't know anything. And then 5 years from now, I'll be looking back at today and be like, man, I didn't know anything.
Yeah.
I think when you keep that always progressing, always improving mindset, that's how you get really great at something. And it's humbling. It's humbling just to realize how little you know about life and business and real estate and everything else.
You just have to be open to receive and learn from anybody. Your kids, your employees, everyone is a teacher, right?
Yeah, that's great. Man, I love what you're doing. I do want to talk a little bit about your multifamily. I mean, we are the commercial real estate show after all. So it sounds like you're invested in a few different markets. Why don't you tell us a little bit about just kind of your general portfolio, and maybe let's do a little forward looking. What are you looking at in the multifamily space going forward?
Yeah, so we like the Southeast market. I gravitated to that market. I actually did go to Ohio first.
Okay.
And looked at that market, Cleveland.
Mm-hmm.
And the town that I was in seemed like there was a lot of nepotism and stuff happening there, and little boy stuff. And I was I don't want to come down. It was close to me. I had a great relationship with, oh my God, I'm trying to think of the name of. They do lending, they do everything. They're a really big lender. I just went to their conference too in the Southeast. It'll come back to me. So I had a good broker that was helping me find a lot of leads in Ohio, and then I just actually decided to go to the Southeast. I have family in Atlanta. From down there, once I started to go there and, fell in love with the process that they have as far as eviction and everything else versus where I was doing it, what I was doing, experience in New Jersey, where it takes forever to get someone out. I was like, this would be great because we can come down and we can add value on a larger scale, right? So low income, affordable housing, stuff like that is what I grew up in. And what gave me my feeling of importance when I got started earlier on was revitalizing the properties, giving the residents a better place to live, adding the properties back to the tax roll. Well, we did those with smaller 2 families, 3 families, 4 families. Then after COVID, we divested that portfolio, took the war chest and went down south. So I started to look at the same type of areas, like where I grew up at, to see where we can add value, to do impact, purposeful capitalism, if you will. And we found that the Southeast was a good marriage for that. So Alabama and Georgia is primarily where we are. And I like the tertiary markets versus the primary markets, better pricing. You can actually, build out things 3, 4, 5 years to come, as long as you're looking at a job growth and income and everything, and the vendors that are there to support that infrastructure for what you see in the future, the vision of being able to exit profitably. If all that pans out and you see where you can make an impact, and that's where you go. So Birmingham, Macon, Georgia, Middle Georgia area, Warner Robins, those areas there is where we're focusing at. Columbus, Georgia as well. It's a great military base area. You have like Phoenix City, Alabama, which is like right next to it, 15 minutes away. So that's kind of where our portfolio is at. And just slowly building it out. For the future, I see us really focusing on building out a portfolio in Macon. Coca-Cola is invested down there. They have a great college. Mercer College is there in Macon. A great infrastructure. So a lot of great opportunities down in Macon. And that's kind of where I see we're going to build some more traction and build out the portfolio there in years to come. Right now it's stabilization, right? Because in the market we're in, it's a great buyer's market. It's tough for sellers, right? And really just trying to find deals that are at least 90% occupied to get permanent financing. If they're not, trying to find sellers that are willing to owner finance at a lower rate. So, trying to just find, deals that are great deals in this market.
Now, are you selling anything right now? Have you had any of those deals that didn't go to plan, or are you kind of holding everything you have and looking to buy more?
Yeah, I'm holding everything I have. We have units that are still under construction that we purchased before the market shifted, like late 2022, that we had some bridge debt on, and things slowed down and we were not able to get traction with that. We had some bridge debt lenders that, didn't fulfill their commitment. Well, we spent money out of our pocket waiting for the draw. So repositioning those to other bridge lenders, we did a lot of that. And then now I would say, we have a good foundation to move forward. So really now is just executing our business plan and creating operational efficiency. As far as average rents that we projected for the ones that were operational with tenants, we kind of beat those numbers. Yeah. We're having some challenges like everyone else with expenses, with insurance doubling and things that are eating into the cost. So just trying to see a better way moving forward, managing that. But right now the focus is operational efficiency. We're not looking to sell anything at the moment because I don't think, it's too much blood in the street, right? People are looking to pay lower prices than what it used to be, 2 years ago. So we're going to hold on. Most of our business plans are 5 to 7 years anyway. I think the oldest property we own is a little over 3 years. So,
got some time. Some time to see what the market does. Yeah. No, that's all great. It sounds like you have obviously multiple deals going on at a time. Do you operate all of this out of your one fund? Is that kind of your model? Like
Correct.
You guys
no syndication. Okay.
Tell me a little bit about that. Yeah.
No syndication. So I looked at the model of syndication, and we bought a 120 unit in Macon, and that deal was set up as a syndication deal. And this was like during Q4 2022 when the 10-year just like exploded and investors was on the sideline. I'm trying to raise capital to close this deal. And there's a term where they say most sponsors eat dog food, right? You put your own money up because you couldn't raise the capital for the equity to close it. So we got 60% financing with the lender through Colliers, and then a great rate, 5.1%. But we had to put up like $4 million. It was a $10 million purchase. We had to put up like $4 million plus closing costs, and we wound up having to eat dog food, as they say, funding it ourselves because the syndication didn't go well. So the fund had to fund it, so it just took ownership of it. And I just looked at the model. I go, we had this hybrid strategy. If we own the luxury spec homes and the multifamilies in one portfolio, if one is not doing so good, it supports the other one. So having that strategy, I mean, there's some benefits also with depreciation that offsets ordinary income, capital gains, whatever. So, we structured it that way. So everything is purchased from the fund.
Yeah.
So investors that are invested in the fund, those are the assets that their capital is collateralized against. So it's not syndication structure.
I love that. And I think that's something I'm really interested in going forward as well, because I'm doing my first syndication right now on a development deal, but I love the idea. The way I look at my philosophy, right? I think I want to pick your brain a little bit on this, but it's the way I look at the philosophy of real estate is I have a pretty broad experience of all these little types of deals I've done, small to mid-size, nothing very super, super large. But I like to look at real estate as when a good opportunity comes, I do it. You know what I mean? I try not to get too much in the box of like, this is where I buy, this is what I buy, this is the deal I do, because I don't think real estate works that way in the sense of markets are constantly evolving, right? What worked 3, 4, I mean, look at your story, your prime example. You have had multiple 3, 4, 5, 6 iterations of your own business because of the way the market changed. I mean, that was the reoccurring theme in your story. Every time the market shifted, you shifted, right? Or before the market shifted, you shifted to stay ahead of it. And so I love that because I think it empowers you with a fund model to take what the market gives you, take the base hits, take the doubles, maybe every once in a while you get a home run, right? Obviously, we love to have those deals that really that exceed our expectations. But when you put that in one fund and now you're raising capital from people that presumably trust you and like you and they want to work with you, they're going to ride that roller coaster with you, right? Good, bad, and ugly. They're going to be on that ride. So with all that in mind, like, how does that work from a practical standpoint? Like, what do you talk to with your investors? How long are they staying in your fund, et cetera?
Yeah, so the different classes in the fund in terms are 2 years, 3 years, and that's pretty much how they work. We used to have a 1-year term, but as the market shifts, you have to also change that. And right now we're looking for investors who's looking to go the long game. Mm-hmm. Especially after 2022, investors were only looking for things that had a 90-day liquidity option, 6 months liquidity option. That was it, right? Mm-hmm. It's only liquid until it's liquid. And then today, fast forward, is 3-year term minimum. So investors coming in, they will invest into the fund. Like you said, whatever capital, whatever assets that we're buying, whether it's a multifamily, a luxury spec home, or it could be something we're just adding an addition to renovate and sell to keep the profits coming in. That's kind of what the capital is collateralized against, those assets. And there's a benefit to that. So as you mentioned, when you see an opportunity, you can execute on it. You don't have to have just this one syndication for this model. Because, as you know, sometimes the syndications don't turn as fast, and investors are making a pref. They want to make that double-digit return that was in a pro forma, and it may take 2-3 years to increase rents, refinance. Mm-hmm. With my model, I'm able to refinance and pay investors off, or sell assets and pay investors off. Some luxury spec homes, pay investors off, and continue to let it go that way.
So how do you, one thing that always was curious to me in these fund models is what happens when you don't have a deal, right? And maybe you have people who want to invest. Are you just telling, are you not taking their money? Are you taking their money? Like, give me through a real, let's say I come to you right now. Yeah.
It's a soft commitment. Okay, we like to deploy the capital within 30 days that we get it because we don't want to pay interest on money that we're not using, right? So then, you have a yield drag in the fund because you're raising capital and you can't deploy. So
gotcha.
You always have to be prospecting for leads, finding deals, so you can kind of keep that pipeline of deals in your pipeline, as well as investors that are giving soft commitments in your pipeline.
Okay.
So, that's
That
kind
makes
of
sense.
one of my mentors told me years ago, you always have to have three things to be successful. You have to have the money, the assets, and scalability. Right? If I gave you $100 million right now, can you manage it? Right? Do you have the resources to buy those, to deploy that 100 million? Okay, now you have the resources, you have the 100 million to buy those assets. Scalability, right? Do you have the right systems and processes in place to efficiently manage that? And you have to have all three balanced in order to, order to execute successfully. And it's a balance in that, right? So
I love that. I love that. That's great. Man, I learned a lot. I know I learned a lot. Any other final thoughts before my final question today?
No, I mean, it's grateful to be here. I always wanted to be on a show, and took me 26 years, but I made it.
Well, like I said, I'm not just saying that. I really learned a lot. I really appreciate your time and your wisdom and 26 years of experience that you shared with us today. My last question for you is, where can our best ever listeners connect with you, find out more about your business?
Awesome. They can go to nngcapitalfund.com. That's the website. You can schedule a discovery call. I'm on all the social media platforms at Fuquan Bilal. If you want to send me a private message to learn more about what we do, or you can schedule a discovery call, and I'll be more than happy to find out what are some of your investment goals and if there's anything that we can do to help you along in your journey.
Well, Fuquan, I as I mentioned, I really enjoyed our conversation. Thank you so much for your time today.
Appreciate you, Joe.
Best ever listeners, thank you so much for tuning in. If you enjoyed today's episode, be sure to leave us a 5-star review and make sure you are subscribed to the podcast so you don't miss any. Thank you all for listening. Have a best ever day.